everyone. So we're here to discuss inside the VC Investment Committee and what will make a deal investable. I think before we're going to do a short round of introduction, I need to thank each and every single one of you for making it through the day. It's not easy, being the last panel of the day, but we have discussed this previously, that we've decided that we're going to do everything but the ordinary here. So we're going to be controversial, we're going to be interesting, we're going to try and talk about the topics that usually are not covered. So think about this more as like a conversation with beer and friends talking about professional stuff rather than a very strict panel. So I hope we're going to have some good time together. Why don't we start with a round of introduction? Dan, do you want to go ahead?
Hi, everybody. I'm Dan Held. I've been in the space for almost 14 years, and previous corporate roles, I led product at blockchain.com in 2013, and I led marketing at Kraken from 2019 through 2022. Over the last couple of years, started to dabble in the VC side of things because I was an operator for a long time, and that's how I ended up becoming a VC.
Hi everybody, my name is Moritz, coming from Hamburg, Germany. I've been in traditional finance for most of my life, running an asset management firm, bought my first Bitcoin back in 2013, and then 2017 set up a vehicle for traditional German investors that want to have an ISIN, however get exposure to crypto, and we have been investing in VC equity, we have invested in liquid token. We have done quite a bunch of soft investments and look into the space of blockchain and crypto.
Hey everyone, my name is Mitch Mechigian. I'm a partner at Fifth Era. Fifth Era is a venture firm. We back funds at the early stage, mid-stage, late stage, done stuff in public markets. So been very committed to the space, but specifically on liquid venture investments.
Hey, I'm Pierre. Work at XPAM. We're one of the larger fund of hedge funds on the liquid side. I run the commercial side of the asset management business, so hopefully can talk to that to help complement some of the venture discussion.
Terry Culver from Digital Finance Group. We're a dedicated Web3 investment firm set up in 2015 with over $1 billion under management. A couple things that I think are different about us. We don't have investors, so our risk appetite and time horizon for return is very different. And we're committed to the resilience and propagation of public blockchains and their censorship resistance. So our definition of investable might be a little bit different.
Yeah, so I think that's going to be interesting to discuss, the different elements here, and we really have a really nice mix here. From different perspectives. I'll quickly introduce myself. I'm Alona. I'm CEO of a ReBlonde PR agency. We do tech, we do crypto, fintech, all of that. Actually been working with DFG since 2021, so really, well versed in the space. Let's start with our first topic, which is crypto as a liquid venture. So the lines are being blurred between VC and hedge funds. Things are changing. Liquidity is changing. Let's talk a little bit about the shift that we're seeing in the market right now. Mitch, if you want to go ahead.
Yeah, I mean, if you look at what's happening in the token market today, right, these are clearly very volatile assets. They're essentially venture assets, right? So you have venture-like returns, but you also have venture-like volatility. And traditionally in venture, that's been illiquid. So you haven't seen that every day. So ventures in crypto specifically is a very unique asset class in that you have this liquid component, both for the good and for the bad. And the industry I think it's most similar to is actually biotech, where companies, they go public in US equity markets in phase 1, phase 2, and they're sort of a 0 or a 1, right? You kind of have this big upside, but if the drug doesn't work, it can go to 0. And so in a lot of ways, when we look at our portfolio, we see that the kind of connection between illiquid markets to public market prowess in terms of the types of investors and types of strategies you need for this asset class are kind of analogous to biotech and sort of converging.
Yeah, so that's interesting. I actually want to hear from Terry a little bit about from the VC perspective because this is a bit different coming from you, especially not with investors. How do you see the change in liquidity and what is currently in demand?
Yeah, I think there's been a real concentration of liquidity in the high cap tokens. I think the old mechanism of launching a project, launching a token, and cashing out is broken. So, there needs to be a new mechanism for financing for new projects. And at the same time, I think there's an enormous amount of capital that's flowing towards the public markets and towards other tech. As a result, I think VC firms have to diversify where they're allocating their investments to see any return at all.
Thank you. We spoke a little bit in our prep, Pierre, about the venture firms increasingly forced into liquid strategies. Is that something that you would like to maybe talk and give your perspective on?
I agree with Mitch. I think it's tricky because as a hedge fund, you think you're trading volatility, but oftentimes you're underwriting the execution risk of something else. And oftentimes for the VC, they're used to seeing something play out over years. Adoption, product market fit, if the right team is really scaling with the investment properly. Here, you're staring at price changing every 5 seconds, every second, and that can create this kind of difficult feeling. And so I think that certainly on our side, when we see managers, we're trying to figure out people who are able to balance both. And that's actually much harder than it may initially appear. So.
Thanks. So Moritz, coming from traditional finance, do you see this convergence being healthy, inevitable, or problematic?
I think an important aspect to it is that we have seen quite a bunch of founders in the Web3 area that were not willing to kind of accept the traditional scheme and give up equity to VCs and sign this kind of contracts. And of course, there have been a bunch of ICOs that burns a lot of money. Nonetheless, there have been quite good communication to founders that said we would like to use a token issuance as a means to get capital. We are very willing to build some mechanism to permit that these token holders somehow, because they are not co-owners, somehow have a vote, have something to say, and they can participate in our success. But we like the idea of a token not only because it's a token, but because it's not equity, and that's something new. And I think that's something we have to accept, that traditional role of equity that has been around for 100 years might come to an end with this new instrument.
Yes, I agree. So if we're talking about taking this a step further to the heated rivalry between token and equity and hybrid structure, Dan, what would be your take on that?
Yeah, I've got two different opinions. On one side, from a fund manager perspective, there's a liquidity mismatch problem with your LPs. So if you're running a venture strategy, you've got to have a very long-term horizon, and you can't have any sort of liquidity mismatch where an LP can withdraw money from the fund. I think some funds are setting themselves up for failure, obviously, if LPs can pull whenever they like to, and if they're engaging in a longer-term strategy, hence why it's called the liquidity mismatch problem. So on the manager side, it's very important that that structure is set up properly. Otherwise, you won't be able to execute the long-term strategy that you'd like. In terms of equity and tokens and what they represent as different financial instruments and value capture, I actually spent a little bit of time looking into this, of the origins of equity, debt, options, futures. And what's funny is, options in the United States weren't created until the 1970s. But the first instance of options being traded were samurai rice options in Japan. So, with any new financial instrument, there was a lot of, if you look at some of the newspaper headlines from the 1970s, there was a lot of criticism of that options would be used as speculative financial instruments, which of course they are, but it doesn't mean that they don't serve a good utility and good purpose for value capture. So tokens, I think, are a new form of value capture. It's a quasi form of equity and also a little bit of value alignment and incentive alignment. My background, when I used to work corporate at like blockchain.com and Kraken, User acquisition costs are usually borne through whatever cash you have, but this is a form of user acquisition where you give them an equity or token stake of the future value of the protocol. So it is a really interesting new financial instrument.
And I guess I just want to ask, do you think that that helps the industry, helps founders, that early liquidity? Or do you think that sometimes, if the volatility goes the wrong way, it can sort of depress the energy in a project, basically? And just a little context, so we are pretty active fund-to-fund investors. We've invested in about 50 funds at the early stage. So when we see our portfolio, it is about 60% equity, 40% token. And in previous cycles, really up until 2023, all of the returns, say from maybe Coinbase, came from tokens. Obviously that's sort of switching now, but I'm curious as someone actually in the field at the early stage, whether you think that's more beneficial or can sometimes actually detract.
There's a couple different really material issues here. One is the relationship between equity and tokens. If you issue both, which one ultimately has seniority? When we talk about like debt with typical like bonds or other forms of debt is senior to equity. Or token, is equity senior to the tokens? There's a weird value misalignment there that has to be figured out in terms of lockup periods or how long founders have access. Typically, we're seeing about like a 3-year to 4-year lockup schedule, which is very typical for a vesting schedule with equity. If you were to found a startup in Silicon Valley, a 4-year vesting schedule is quite typical. As long as the vesting schedule is aligned with them producing value and creating the company, then I think it's pretty aligned. And again, I don't know of a better schedule than a 3 or 4-year one, as that's typically what Silicon Valley has done for the last 20 years.
I guess you can imagine, though, so you said you were at Kraken earlier, is that right?
Yeah, Kraken and blockchain.com.
Yeah, so the Kraken, we're big investors in Kraken, Allison, co-partners on the board. But you can imagine the ride at Kraken would have been this wild up in 2020 and then a down, and then now they're doing extremely well. And there is some benefit, I think, to the illiquidity of equity, and with all of the employees and everybody there, didn't get so down because you didn't watch, oh my God, my stock options, they didn't go to zero, the way you kind of are in the token market, right? We're in a number of token projects as well, and sort of Helium is a famous one that's doing very well on the equity side. The token's extremely depressed. It creates this weird problem.
As a Kraken equity holder, it's a blessing and a curse. So I don't disagree or agree with you. One is that no one has an infinite, low time preference. Like I worked at Kraken starting in 2019. It's 2026. 7 years to wait for liquidity. That's a long time. So yes, I've held it and we've gone through it. And I've sold a little bit too in the secondary, but I still have a significant portion. You go up and down, you have these swings, but the optionality to be able to sell, for example, let's say, heaven forbid, I had a health crisis. Not being liquid or having it being really illiquid kind of sucks for different life events. Or say if I wanted to buy a home to start a family. So yeah, it is a forced hodl. But I do think SpaceX and OpenAI are doing it the right way, where they have tender offers, where every so often they offer liquidity to their employees from the company itself. I think that's a nice, very structured process. Versus Forge Global is a way that employees can get liquidity on the secondary markets, where I go to Forge, I'm selling 10,000 shares of Kraken. Forge pairs me with a counterparty. Forge takes 5% on both sides. So pretty huge spreads, but that's currently how most founders get liquidity for equity on the secondary market. Anyways, incentives have to be aligned, and yeah, a forced hodl is sometimes good, but we don't all live forever.
So Terry, you wanted to say something?
Yeah, I want to go back to the comment about risk and options. And I think there's one fundamental difference between traditional options and tokens, and that is traditional options are really designed or function as a way for people to manage risk with an underlying asset, whether it's rice or corn or oil. And you don't have that utility with tokens, or even necessarily with options on tokens. And so I think actually this speaks a little bit to the maturity in the crypto ecosystem that needs to develop further, which is around managing risk in volatile markets.
Thank you. So with all of that and those mix, M&As can sometimes become a bit more risky or interesting, especially given if one side of the cap table survives and the other does not. Pierre, do you want to share a few thoughts on that?
Well, I suppose these instruments are useful for different things, and that's where you should start. So if I'm buying something, why am I buying it? If I'm after a team or some sort of IP or regulatory perimeter, I imagine I'm better off with the equity because I'm going to coordinate behavior more thoughtfully that way. If I believe in liquidity, network effects, the user base, I'm probably better off with the token. The issue is, if I go for the token, do I have to buy all the tokens in circulation? Do I have to buy a majority? Do I retire them? How do I make them neutral? Are there going to be weird post-merger integration issues because a minority of token holders create a small riot against the decision to buy? And so like all these things I think are not resolved. And in general, I do think that it's tricky because when you invest in both the equity and the token, you feel, hey, I've got optionality, right? One might work, one might not work. Maybe there's some downside protection. What could, I'm covering all my bases. And I think the problem there is that it may be actually deferring conflict to a time when it's much more painful to deal with. And so I would imagine you either want something where the outcomes of both are like so clearly aligned from the get-go that they can coexist, but that feels rare. I think people usually cite Uniswap as like the classic example of stuff that seems to have worked, but most things I don't think have that great story. And so maybe you start with one and collapse it, and then you stick with the other. But having this thing go on for a long time, I think it's also very difficult for institutions, right? They may see something be listed as a token, and lots of people come into the marketplace because they don't have the same restrictions necessarily as the institution. They buy into it, and then maybe the fundamental value is already priced into the token, and it's harder for the institution then get involved. It's very tricky business, but in general, I find it hard to believe that both can coexist for a long period of time as something scales.
Thank you. So Moritz, actually, what was mentioned now about what's happening post-deal is pretty interesting, and I would love to hear what you think about the confusion that people might experience of the token worth, and what does that worth mean post-deal?
I fully agree with Pierre that the tokenomics in many cases have not yet been developed to a state where we can really say it's comparable. So if you want to be on a safe side, it's always better to have at least some equity. However, we have seen Uniswap, which was a first step towards giving some kind of a dividend entitlement to token holders. And we have seen more and more. We recently invested into a project that financed itself via a token. However, each and every token, which was in the format of an NFT, would give the holder the right to run a node on the future network. So that was something quite interesting to me. So it was not pure equity. However, it was the right to participate or to sell the right to run a node, which is the key to generating revenue if the project is. So you might be able to compare it to the right to a franchise of McDonald's, for example. And that was quite a new invention they made. I wouldn't say this is an ideal setup, but I like it much more than the most recent developments where you have a guaranteed burning mechanism that will somehow translate in the token to appreciate if the project is getting better. I think we will see some innovation on this side.
Thank you. So we're more or less halfway through. Let's do a quick icebreaker. I'd like to maybe hear from each and every single one of you a short anecdote, a story about a deal that was, either 100% not investable, but yet you had to go with it anyway because reasons, or something that really yelled a red flag that you think would be an interesting story to hear. So, just go ahead and share them openly.
I guess I'll start. We've looked at probably, our fund has been around for 2 years, and we focus on the Bitcoin DeFi category, so DeFi on top of Bitcoin. We probably looked at over 260 deals in 2 years, and we've invested in 9. There's a lot of reasons why we don't invest. There were some where we've seen we've gotten like 2 decks in the course of a couple weeks, and we see one person pop up on both, and we're like, so which one are you working at? You know, there's some weird ones like that where there's a lot of folks who say they work at a crypto company, but they're just kind of consulting, and or they just put their name on a deck, but they put their name on a couple decks. There's one individual in crypto that I'm not going to name who does this often, and I don't know why other founders put him on the deck, but they seem to do it, and we saw him about a dozen times, which is an automatic red flag. So that seems to be a weird one that, you know, in traditional Silicon Valley, I spent 10 years in San Francisco. That's like that's a pretty big red flag. That's like your name's getting circulated in the circles and no one's going to talk to you again. You know, crypto, unfortunately, attracts really bad actors, and so a lot of people get away with things like that. But that's an example of something that we see that's common, semi-egregious, and a big red flag for us.
Yeah, go ahead.
I'd have an example where we invested in equity of a startup that was doing tokenization as a service, which at that point in time we found quite challenging. They had difficulties getting new clients on board, and they were run out of cash. And then they said, okay, we are now going to do a token launch. I said, okay, that's a smart idea. So what is the purpose of the token? And they said, yeah, token holders will get a discount on tokenization services, which we are not able to get on board. And we did not invest, and the company went into bankruptcy. But I think doing the token, really, it needs to have a clear purpose and a value proposition. And that was one of the examples we had where we were quite happy to, well, have equity. However, the company is not doing too well. But the token is not an instrument to replace proper financing. It needs to have a purpose and a value proposition.
We all remember the time where we had to talk to anonymous people and invest in their ideas or startups, right?
Yeah, you remember, that's ours exactly. So we've been in the space for a long time, and back in 2020, 2021, in the heyday, you would see anonymous teams. And so I think, you know, in that sort of bull market sort of euphoria, a lot of the diligence parameters and checks get loosened, unfortunately. You know, we didn't back any anonymous teams, but I don't think many of those projects ever worked out for obvious reasons. So that's definitely a massive red flag. And, you know, another little anecdote there, right, is that FTX, though it was a, you know, multi-billion-dollar company, multi-billion-dollar valuation, didn't actually have a CFO, right? So again, and that was backed by, you know, tier one, you know, traditional VCs, growth investors, you know, large national pension funds. So it's really just amazing what happens in that euphoric state. Thankfully, that's not really happening in our industry right now. It's probably happening in AI. So people in crypto VC now are much more, you know, I'd say very diligent in those types of things.
I think for us, it's the same thing every time, which is don't fall in love with the managers. And so oftentimes, I think the biggest risk is if performance masks a different kind of fragility in the manager. So sometimes people have incredible performance, and it's very attractive. And then you peel back the onion, usually operationally, and you see that either something is really missing or you know, there isn't really risk management. And so if there is, like the last few months for a directional fund, a downward pressure, whatever the source, I'm much more interested in how managers lose money than how they make it. And I think that is not, unfortunately, that common yet in crypto. And the thought is, well, even if this isn't fully operationally set up the way it would be in TradFi, it's a new industry, things are evolving, you know, there's kind of a forgiveness that's given, and that's something we have worked very hard to kind of remove. So we have some of the best performing managers we saw, we did not invest in, and that's hard to do. So I would say it's just don't fall in love with them.
Thanks.
And to your point about euphoria, I often think that you know, venture investing is just an elaborate exercise in survivorship bias. You know, you hear about the great successes or unicorns, but you don't hear about the thousands of projects that were decent and failed, or even the many more thousands of projects that were garbage. And for us anyway, it's rarely a case where it's purely uninvestable or purely investable, at least for the projects we look at. It's usually a hybrid, and you try to manage those risks. As you were talking, I was thinking about a company we invested in a long time ago. It was one of our first investments. It was a Bitcoin derivatives exchange, and they were trying to get licensed. And before the regulators really had any education about the asset class. And we had concerns about that. We had concerns that one of the founders was as volatile as the asset class was. And we had concerns about the product market fit. And over the course of about 4 years, all of those concerns materialized to the point where the founder had a drunk tweet tantrum against the regulator going on for a couple days. They couldn't get customers. It was, anything that could have gone wrong went wrong. And ultimately, it was actually one of our most successful investments. And I highlight that just to point out that at least, if I'm being really honest, when we do decide to make an investment, the chances that it succeeds are as likely as the chances that it fails for reasons well beyond our control.
Yeah, I just want to add to that. I mean, venture isn't about not making mistakes. I think that's really the hard thing, right? So at the end of the day, everyone's going to have a bit of egg on their face because at least our view is you need to be in those big winners. So you need to be out there taking risks. It's not like private equity where it's about not losing money and 10% IRR and very safe. In venture, you need to be kind of on the edge. And so you get these cases, I don't know if you agree, but you get these cases where, 3 years later you go, oh, what were we thinking there? But you kind of have to be out living in that world or you're never going to be in, the next stablecoin company, because when people were doing the seed round of Circle and Tether, it looked absolutely crazy, right? But now you look like a genius, but you had 70 other projects that now look completely idiotic. So it's kind of that fun, fine line we live in.
I kind of think about it like you've got back to like a finance term, a random walk from the point of investment to a spectrum of different outcomes of failure states and success states. You can eliminate some of the more predictable fail states. For example, making sure the company is set up properly, there's clean incentive alignment, founders are pedigreed. That reduces some of your risk. It doesn't eliminate it, nor can you really model it, but it reduces it. It reduces the number of random bad outcomes. Similarly, there's filters where spending 10 years in Silicon Valley, all we do there is network and meet other founders. And I've met thousands of founders. I mean, some of these folks are my friends. You meet them at parties, happy hours, dinners. You get a lot of repetition of seeing what good looks like. There's still not a formula for it, but you certainly know what bad looks like. And you know what some of these characteristics are. For example, like, does this seem like a fair weather founder where they're just trying to find a narrative market fit with VCs and they're trying to raise some money? They're going to coast for a couple of years, the company fails, and then they go do their next thing. We call these serial scampreneurs, so like scam entrepreneurs. Basically, there's this type in Silicon Valley. So, once you see that, there's some pattern matching there of like, okay, cool, that's like a non-investable type person, or this person doesn't seem like they'd have grit, or this person, this is their first startup, which it's possible that they succeed, but the probabilistic, weighting of them succeeding is low. So yeah, it's pretty random. Your outcomes are pretty random. You're trying to swing for the fences. At the same time, I do think there's a little bit of ability to minimize more predictable downside risk.
Also,
Yeah.
if I could, I think at least for us, and I'd be curious to hear if it's true for you folks as well, sometimes we'll make an investment not because we think that that particular investment is going to have an enormous return, but it will have knock-on benefits for other things that we want to do. So for example, you mentioned Circle. We were the lead investor in the build and launch of USDC. That was not genius whatsoever. In fact, we thought if we broke even on that, we would be lucky. But we felt at the time it was very important to have a US dollar denominated, US-based stablecoin company to help the ecosystem grow.
Okay, so on to our next topic. The origin or the source of money is changing these days. Where is money coming from is a little bit shifting. Crypto in the current political era has dramatically shifted that. I will keep it open to anyone who wants to kind of like talk a little bit about the changes you guys have seen in the past years of like, where is the money coming from?
I think it depends on the product. So if you have a low beta coupon-like product that does what it says on the tin, you're going to get risk-sensitive people to look at it. And so I think of the old world in Europe. I think of some of the conservative RIAs back home in the US. And there's nothing wrong with this. It's literally you make a menu of products for different types of appetites on the risk spectrum. So it might be that a sovereign wealth fund it has a very long-term view, and so for them, preserving the capital and having the same kind of return every year is really important. As long as you have good counterparty due diligence, they'll go for it. If you have something very directional, then you're probably going to get a family office. You're probably going to get a group that is more crypto native, or it's going to be the son or the daughter that's inheriting from a patriarch, wants to sort of, over time make their own name, and is very comfortable with convexity. You could also do a structured product, where you have some outcomes that are defined, and you use math to collar returns, and that'll get a different type of person who is. So it really, really depends, but in terms of where capital's coming from, I'm sure everybody on stage is seeing more from the Middle East. I'm sure they're seeing activity also in countries that understand crypto. So for example, we had interest from El Salvador, which was really curious, right? Because if you visited that country 6-7 years ago, you would find that it was not actually investable. And today they've completely changed everything to the president's credit there. And because of the legalization of the tender, they're now investing in a way that's ahead of some of the American companies that I used to raise money from in private equity. So that's how I would answer that. It probably depends, but generally more the Middle East I'm seeing, and some country-specific things that understand crypto.
Yeah, I sort of took the question slightly differently, and what are the funding models of the future and how are they shifting? And I think the kind of most interesting thing, which we actually haven't participated as a fund, but I'm curious if the other VCs have, are using tokens to aggregate capital at sort of warp speed across the internet globally. And this is fueling a lot of scams, meme coins, things like this. But if you kind of just step back, even when President Trump launched his meme coin, which is not investment advice, I wouldn't invest in it. It did aggregate about $10 billion of capital within a few hours on the Solana chain, which was really actually just incredible to watch. So there's definitely something very interesting there. You're starting to see projects like Hyperliquid, a few others, actually sort of bypass traditional VC funding models. So I don't know exactly where it's heading, but it definitely seems like there could be a there with sort of distributed, global, retail-driven capital funding models that are sort of crowdfunding on steroids, for digital natives.
That's something I found quite fascinating, that setting up intelligent token investments, which are not so often around yet, will be an instrument where not only professional, distinguished investors get attracted, but where individuals, where retail has an ability. And I mean, the underlying concept of blockchain is decentralized and everybody is able to participate, and you don't need banks or hedge funds or even fund of hedge funds. You can do it directly if you can bear the risk. But that's something I would very well imagine that this is going to happen in the next 5 to 10 year kind of brackets, that more and more really juicy projects get money just by launching a token, and everybody who's interested can just press on a button on the internet and take part in it.
Kind of like the ICOs.
2.0, yeah.
Yeah, and that's the thing, is our industry sort of started that way, right? Ethereum was an ICO. A bunch of the best projects were ICOs, and because of the SEC regulatory crackdown, it sort of forced, it actually was a boom to our industry, it was a boom to VCs. VCs arose to kind of fill the gap that the closing of the ICO market had. Now, of course, there are good reasons to do that, because there were vast majority of ICOs were scams, were rug pulls. You have issues, none of the regulation exists, insider dealing, disclosure on share ownership, trading, things like this. So it definitely needs regulation to create guardrails. But again, some of the most successful projects still to this day were sort of not VC institutionally backed.
And the number of scams was similar when the CFTC was set up, and back then options and futures become tradable. So half of the offerings were just scammy. And every innovation in the financial services area brings some people with it that are there just for the money and not for the value.
And to Mitch, to your point earlier, I think that there are a lot of L1s that have these vaults now, where it's some underlying that somebody wants to keep. They pledge it into the vault. The vault borrows USDC. Obviously, there has to be some KYC, AML stuff at the entry and the exit, but then that USDC funds some sort of strategy. And we know one manager that has a big market neutral fund, and he's raised a lot of money that way. So it feels like there's a sort of maybe a creative way of reusing some of the investments that have not found the outcome they were looking for yet. And that's a way of, I guess it's a centripetal force, bringing stuff together. So that's something I've noticed.
So how do you guys see investors being looking at the structural differences between Europe and the US and the UK? Those changes, those shifts that we've had in the couple of years, how does it change their approach to looking at investments, in the geopolitical aspect?
I'll take a first stab at this and go ahead and get a little controversial. Look, as an American, obviously I lean more American with the way that we do business. But if you look at American exceptionalism, the amount of value creation in the American culture is phenomenally higher than everywhere else. This is undeniable. You look at trillion-dollar companies, those are based in America. You look at the complete dominance of operating systems, mobile hardware, computing hardware, American. AI, American. Space, American. There's a reason why. And the reason is that we still enjoy capitalism. And we still enjoy working hard. And the amount of work ethic that people in Silicon Valley and New York have is a level that I have never seen in Europe. No offense. These people are savage, sharks. They spend their entire life thinking about work. They go home, think about work. They work all the time. They work 80 to 100 hours a week. That's who you're competing against. The Chinese are that way as well. I think Europe needs a wake-up call where this is one of the most incredible continents in the world. The history here, I enjoy spending time here, but the work ethic is less than the US and China. And I think that has led to the disconnect in GDP growth. And not to throw such cold water out there, but it's a continent that I wish would kind of embrace capitalism again, and that really extreme work ethic that America brings out.
Maybe just what do you think about the kind of foundations of crypto that to me were more European-centric than, let's say, even the internet, Web 1.0, which is clearly American. Even AI is clearly very American-centric. But obviously, Vitalik, Ethereum Foundation, Berlin-centric, obviously big nexuses in Switzerland and Portugal as well, and obviously a huge Asian component, right? We have this sort of, Binance, all of these mega exchanges we don't even think about here in the West are Binance is 10, 12 times the size of Coinbase. I mean, in a way, crypto has been more global, and I feel like I live in London. Our fund's based in the U.S., but I feel like London just missed the opportunity to capitalize when the U.S. was going the wrong way. Europe sort of tried but stumbled. But I mean, what do you kind of think about at the beginning? Right, it didn't happen outside of the U.S., but it was more kind of global than other technologies.
I agree. It was definitely one out of AI, drones, everything else. This was a global phenomenon, which is awesome. I'd love to see that. And it was interesting. I was in San Francisco when it started there. The January 2013, there was a meetup group called 20 Mission. It was on 20th and Mission Street in this former crack house that was converted into a co-living space for developers to live and work. So there's only a dozen of us at the time. It was Brian and Fred from Coinbase, Jesse Powell, Jed McCaleb, Mt. Gox, Ripple Stellar, Charlie Lee, Litecoin. The Bay Area talent was deep. Like that was pretty cool to see. So I would say like San Francisco in the US was the hub of where a lot of that development happened. What's interesting is since it's a financial, financial technology, we didn't really see New York though. New York also kind of missed on this. So London and New York being financial hubs, I think for them it was just too esoteric, and the culture was just not conducive to leaning into that. So that's where crypto, I think, was more of like a Bay Area tech global phenomenon than a traditional financial hub phenomenon.
So I see the world very, very differently. I think the success of U.S. companies are not due to any kind of inherent American exceptionalism. I think it's due or even a greater work ethic. I think it's due entirely to a stable regulatory system and a large and active consumer market that migrates from shopping to investing.
And a single market with one language and
Yeah.
everything harmonized, unlike
Yeah.
the EU with different
Yeah.
languages. And
Yeah, and not to take anything away from talented, hardworking entrepreneurs and hardworking people, nothing like that. But if you look at other markets, India, almost any market in sub-Saharan Africa, South Asia, capitalism is alive and well and thriving. And those people, in large part, would work harder than anybody in the US, I would guarantee. So, I think there are other things at work here. And maybe to put a fine point on it, once the current administration came into office and there was a regulatory shift in how crypto was treated, there was an immediate inflow of talent, of businesses, and companies trying to get listed in the US. All because the market was now friendly to them in a way that it wasn't before, and they could grow there, they could get listed there, they could raise capital there.
Okay, so that was very interesting. We actually never even got a chance to talk about AI, which was our next big topic. But I do think we hit some interesting points here. And I want to thank you so much for your time, and I hope you enjoyed.